Hello and welcome. I'm Financial Standard Deputy Editor Mark Smith, and today I'm joined by BetaShares Managing Director Alex Vynokur, and we're here to talk about the group's high-interest cash ETF. Hi Alex, thanks for joining us.
Thank you, Mark. It's great to be here.
Can you tell me the background for releasing the high-interest cash ETF and what problem you were trying to solve for advisors?
As an Australian ETF issuer, we are always focused on the Australian market. And having looked at the Australian market in terms of various asset classes that are available for investors in the ETF form, we have seen that one of the key asset classes, being cash, has not really developed into product offerings which deliver value for Australian investors. So we have spent a fairly considerable amount of time speaking to financial advisors and end clients. And one thing that stood out is that there is an opportunity in the Australian market for a competitive cash offering being available in the form of a transparent, liquid and simple to understand ETF.
What other options are there for clients looking for cash exposure, and how do they differ?
Generally for financial advisors and their clients, especially those that use investment platforms, the default option is really the cash offerings that are available, sort of through that investment platform. Having looked at the interest rates that are available to investors, and the average at the moment across the top 3 investment platforms, it's just around the official RBA rate, which is 2.5%. We have seen a disconnect between the pricing that's available to advisors and to clients on those financial platforms and what's actually available directly in the retail market. So the purpose of building the high interest cash ETF is really to bring a more competitive cash offering forward to advisors and their clients through the investment platforms, if they choose to do so, or as simply as just purchasing a share on the ASX.
Can you tell us how the cash ETF works, how the portfolio is constructed, and how income is paid?
So the BetaShares Australian High Interest Cash ETF invests money at call with 4 Australian banks. Since inception, the ETF has generated and has continued to generate interest rate, which is 95 basis points above the RBA cash rate, which, if you compare that to the interest rate that I was mentioning before, which is the average across the 3 largest platforms, it's almost 1% per annum higher than what may be available as the default, as the default at-call cash option. So the interest rate is fairly attractive. It's paid out monthly, and there is a dividend reinvestment plan available for those who wish to reinvest, their income. So on one hand, it compares quite favorably with at-call options. Of course, there are other options available for investors, such as term deposits. People who don't require the liquidity, may choose to invest in a 30-day, 60-day, 90-day, or 1 year, term deposits. Having recently looked at the 1-year rates available in term deposits, we're seeing that an average across the, the big 4 banks is somewhere in the order of 3.3% per annum, which is currently 80 basis points above the RBA rate. Once again, the BetaShares High Interest Cash ETF is at the moment generating a slightly higher interest rate than that, but importantly, investors are not foregoing the liquidity, because like all other ETFs, and the ASX code for that ETF is AAA, investors are able to buy and sell that ETF like any other share.
And how does one actually trade the product?
So this ETF, like all ETFs, is quoted on the ASX, and investors are able to buy and sell this ETF like any other share. So as I was mentioning previously, the ticker, the ASX ticker for this ETF is AAA, and investors are able to buy and sell it with T+3 settlement, like all other shares.
So summing up for us, what are the advantages of the cash ETF over an at-call or term deposit account?
Look, I think what we typically see from investors is that setting up at-call accounts or term deposits for clients often involves quite a significant amount of administrative work. So filling out the paperwork to open up a new account or switching from one investment account to the other. And what we typically see is that the banks would quite often offer an introductory or honeymoon rate to investors, but after some time, whether it's 3 months, 6 months, that rate tends to tends to revert back to the default rate, and the default rate is not always a competitive rate. So one of the key advantages that we're seeing from an advisor's perspective is being able to use this ETF in a way which delivers a competitive return on cash for the client, but at the same time significantly reduce the administrative burden of having to open up bank accounts for hundreds and in some instances thousands of clients at any one point in time.
Thanks, Alex.
Thank you for having me, Mark.
Well, there's a wealth of information there for you to get your teeth into. Thanks for joining us here on FSI TV. We'll see you next time.